Hello, everyone. Welcome to NCST's monthly community impact briefing. I'm going to give folks a few minutes to join us, and then we'll get started. If you are just joining, you are on NCST's monthly community impact briefing. We're giving folks just a couple of minutes. We had quite a few registrants today. We're giving folks just a couple of minutes to jump on before we get started with our topic today.
I see the numbers leveled off. Erin, should we go ahead and get started?
Yep, we can go ahead and get started. Again, welcome to NCST's monthly community impact briefing. My name is Erin Persons. On behalf of my colleagues at NCST, we're happy to have you here today. Today, we're going to talk about protecting homeownership from the impacts of COVID-19, the COVID-19 pandemic. And we're lucky enough to be joined by one of my colleagues, as well as Debby Goldberg from the National Fair Housing Alliance. And we're excited about sharing this research and recommendations with you today. As a reminder, everyone is muted. There will be an opportunity for Q&A, and the slides that we're about to show will be posted on our website by tomorrow, along with a recording of this call if you'd like to go back. To ask questions, you can either utilize the chat feature or the Q&A. And with that, I will turn things over to David Sanchez, who is our Director of Research and Development, to introduce Debby and get started with the presentation. David?
Great. Thank you, Erin, and thanks to all of you for joining us today. As Erin mentioned, I am the Director of Research and Development here at NCST. And as such, I am a member of our policy team, as well as I'm one of the authors of the report that we're here to talk to you about today, which is called Protecting Homeownership from the Impact of COVID-19. I just put a link to the panel in the chat. It's on our website. It's on the National Fair Housing Alliance's website. And it's also, the paper was sponsored by the National Association of Realtors. So I just put the link to the paper on the Realtors website in the chat. To give a little bit of a high level, preview of what we're going to talk about today and what the paper does is, it really looks back at lessons from the last crisis and considers what might be different in the homeownership space as a result of COVID-19 and what risks are the same as those that we saw from the financial crisis. So the report goes through a lot of data and provides an overview of the risks to the mortgage market that COVID presents, essentially, and also the risk to homeownership. Debby's going to, in just a few minutes, give a kind of a walkthrough of that data and what the paper says there. And then the paper also gives a policy framework for thinking about our response to COVID-19, and it offers recommendations in two areas. And those two areas, broadly speaking, are recommendations related to people and recommendations related to properties. So I will say more in a few minutes about all of that once we hear from Debby. Just to introduce Debby Goldberg, for those of you who don't know her, she is the Vice President of Housing Policy and Special Projects at the National Fair Housing Alliance. She is one of the co-authors of the paper that we are talking about today, alongside Julia Gordon at NCST, Lisa Rice, Diane Chipolone, and Lindsay Augustine at the National Fair Housing Alliance. At NAFA, Debby works to ensure that federal housing policy effectively addresses the needs and rights of people of color, families of children, people with disabilities, and others who are protected under our nation's fair housing laws. She also leads NAFA's work with its members and allies to ensure that all neighborhoods are communities of opportunity. Debby is a longstanding friend of NCST. She's someone who I've had the joy of working with in all of my jobs in housing policy so far, and I couldn't really imagine it any other way. So we are very happy that she is here to join us today. So I think with that, I'm going to turn it over to Debby. We'll have Erin pull up the slides. Debby will present, I'll present, and then we'll turn it back to Debby at the end because she's also going to give a quick update on some of what's happening at HUD after we finish this paper, talking about the paper. So Debby, I will hand it over to you.
Thank you, David, and thank you for that very kind introduction. I want to start by just saying that it was a real pleasure for us at NAFA to work with NCST on this paper. I don't think we could have found a better partner to try and really capture some of the lessons from the last crisis and figure out how they do and don't apply to the one that we're afraid we're facing now. And we're also really grateful to the National Association of Realtors for supporting this work. You know, I think the NRA had a real interest in trying to make sure that the outcome of the impact of this pandemic on the housing market doesn't undermine opportunities for home ownership broadly, as is kind of their mandate, I guess, you know, in the market. But I think for our two organizations, NAFA and NCST, within that kind of broader framing, we had a real interest in making sure that this pandemic and its impact on the housing market doesn't have a negative impact on people and communities of color, because those are the folks that, you know, we are focused on in particular. And I will just say personally, I suspect this is a sentiment that's more broadly shared. We are still feeling the trauma from the foreclosure crisis that happened, you know, over a decade ago, and the impact that it had on the communities and the constituents that we serve. I think, you know, one of the lessons that we took away from the public policy response to that crisis was that it was too focused on serving the needs of the financial system and shoring up that system and its major institutions, rather than focused on the needs of the borrowers that are the engine that drives the financial system, and the communities that are the backbone of the economy that it's supposed to serve. And really the interventions for homeowners were too little, too late, and too complicated to be able to avoid really negative impacts on communities of color and borrowers of color in particular, as well as on many others. And we think that it's really important moving forward to take a different approach. So let's dive into the slides. Erin, if you'll advance two, really, because I want to talk a little bit about how we're seeing this pandemic and its impact, and in particular, its impact on communities of color, because they are really feeling the brunt. So we know that right now there are about 2 million households in forbearance, which is down from a high of 4.8 million earlier in the pandemic. And so that's a good sign, right? We're making some progress. Of the folks who are still in forbearance, about 836,000 are FHA or VA borrowers. And we know that that FHA portfolio in particular is likely to be to include a significant number of borrowers of color. And then about another 641,000 households in forbearance have GSE loans, and another 580,000 or so have loans that are either held in portfolio by banks or in PLS. So there are just under 650,000 delinquent borrowers who are not either in forbearance or in some form of loss mitigation, which is a noteworthy chunk of folks, right, who haven't been helped or been able to take advantage of the protections that have been put in place, which are really notable, right, the CARES Act protections. Of that 650,000 or so delinquent borrowers, 184,000 are seriously delinquent and therefore at imminent risk of foreclosure. When we think about who has been affected in terms of employment by the pandemic, it's been 20 million US workers overall who have suffered from the economic crisis. And, no surprise here, the unemployment rate among Black workers is almost twice that of the unemployment rate of white workers. And for Latino workers, it's about 1.5 times that of white workers. So on the unemployment front, the brunt of the pandemic has been borne by people of color. That's true from the health impacts as well, right? That we know that Black, Latino, Native American, and Asian American Pacific Islander residents have been more likely to get the virus and more likely to die from the virus. And so those factors combined, we see when it comes to housing, there's a disproportionate impact as well, that 43% of Black, 37% of Latino, 18% of white adults say that they're having trouble paying their rent or their mortgage. And we know that borrowers in zip codes where the majority of the population is Black are twice as likely not to have the protections, the forbearance protections of the CARES Act. Can we move to the next slide? So there are some real challenges then in the marketplace. One is that the CARES Act only covers 70% of the market. So we got that 30% of folks who don't have the same access to forbearance as others. We see higher rates of delinquency in the FHA and VA books of business. And as I said earlier, the FHA book in particular, we know is going to contain a lot of borrowers of color. More than half of the borrowers who are exiting forbearance need help. They don't have the income to resume, regular payment of their mortgage, and they're going to need some kind of loss mitigation. That is a real pain point, right? We know from the last crisis. And unfortunately, while these numbers are much lower than what we saw the last time around, we still expect that there may be somewhere between just under 250,000 or up to 500,000 of foreclosures before this thing is behind us. And projections are that the inventory of REO properties is likely to peak at 175,000 just a couple years down the road. Next slide, please. So those factors exist on top of a landscape where we have really persistent challenges in terms of fair housing and fair lending, right? I think all of you know that there is a tremendous amount of inequity in our society, and that much of that is related to race and national origin. And so these factors really complicate, our ability to make sure that people in communities of color are protected going forward. And those are things like the kind of deflated property values that we see in those communities. There's been a lot of attention recently to appraisal bias, which is one of the factors playing into that. We have persistent racial segregation in all of our cities, pretty much across this country. We still see steering in the real estate market, so that borrowers are steered to communities to look for homes based on their own race and the racial composition of the community. And we still see discrimination in the way that REO properties are maintained when you compare what happens in white communities and communities of color. Next slide. And there are some real challenges in the marketplace overall. And some of these are very different than what we saw, 10, 12 years ago, right? Then we had really the economy circling the drain and housing prices plummeting. Now what we've got are booming housing sales and really a restriction in the amount of home building that's taking place, both of which are putting upward pressure on home values. We see that cash is a queen or king, depending on your perspective there, and that cash buyers are really squeezing out ordinary home buyers who are relying on a mortgage in order to be able to make a purchase. We're seeing the increasing use of auction sites to sell homes, and that also puts real pressure in terms of the ability of borrowers who need to get a mortgage in order to purchase. And we're still operating in a restricted credit environment in which we over-rely on credit score, LTV, and DTI to get access to credit. All of this together means that it's very likely that borrowers of color are not going to be able to bounce back unless we intervene effectively, strategically, and quickly. and that options for homeowners overall are going to be diminished without those kinds of interventions. So as David said up front, our report has really two groups of recommendations, some related to people and some related to properties. And I'm going to turn the mic over to him to walk us through those.
Great. Well, thank you, Debbie. Erin, if you don't mind advancing to the, just go one more slide after that, that'd be great. So, within the general frame of policies related to people, I think that there are two main strategies that we think are going to be central to responding to the risks that COVID presents to homeownership. The first one, which I touched on this slide, is preventing unnecessary foreclosures and unnecessary home loss as a result of the pandemic. And as you'll see on the next slide in just a minute, the other set of recommendations related to people really center around ensuring that households can access sustainable and affordable mortgage credit. Within the preventing foreclosures and home loss area, our first series of the paper walks through a series of recommendations under these headers. There's actually a lot of detail in the paper, and I hope that many of you will go and take a look at it. I'm going to touch on kind of conceptually what we mean here, as well as a couple of really high priority policy recommendations, and then just with the note that there's more in the paper for those who are interested. The first recommendation has to do with increasing access to COVID mortgage forbearances. As Debbie referenced earlier, about 70% of the market has the protections, the forbearance protections that were created in the CARES Act. We think those are critically important. We would still love for those protections to be extended to the full mortgage market, although recognizing where we are in the pandemic, we don't know if that's necessarily going to happen. Within the, in addition to that, we do think that there is a role to be, a continued role and even a greater role to be played on both by servicers and the federal government in making sure that borrowers understand their rights and understand that the really good option of a CARES Act forbearance is available to most of them. And even if you aren't technically protected by the CARES Act, many private institutions are imitating those forbearance protections, and borrowers just need to be aware of that. Our second set of recommendations is about giving borrowers the post-forbearance options best suited to their circumstances. As Debbie referenced, about slightly more than half of borrowers, when they come out of forbearance, they have trouble paying back the amount that they owe, and they need a little bit of help to do so. Broadly speaking, the two tools that are really going to be used, we think, are either deferrals or partial claims, which is essentially where you take the amount of money that you owe and you put it at the end of the loan. And the other option is going to be something that we all know well from the financial crisis, which is going to be loan modifications. And that takes the amount that you owe and capitalizes it into like a newly restructured loan that hopefully reduces a borrower's payments. Within this category, one thing we want to call attention to is that most people interpret, or servicers in particular, interpret the guidance they get from particularly FHA, but also the GSEs, as you have to offer options according to a waterfall, which is they're offered sequentially. So people will offer a payment deferral first, and if they say, yes, I can afford to resume making my earlier payments, they will be given a payment deferral. But there is actually options further down the waterfall, quote unquote, that can help reduce their loan payments potentially through a loan modification or maybe through a combination of options. So, one recommendation is revisiting kind of how loss mitigation is offered and questioning that waterfall structure, instead giving borrowers kind of a full menu of options that they might qualify for. Within this recommendation, we also in the paper touch on a number of enhancements, particularly to either the deferral or the loan modification options that are offered by the GSEs and FHA. I think we are happy to report that in the time that the paper has come out, we have seen both FHFA, which regulates the GSEs, and FHA do a lot of work on improving their loss mitigation waterfalls and programs. And while we think there is more to be done, I think it is really encouraging sign that the agencies are putting as much emphasis on this recommendation as we think that they should. Our third set of recommendations related to preventing foreclosures and home loss is about encouraging communication between borrowers and mortgage servicers. We know that the exits from forbearance in September and October are going to be huge for the industry, and that the industry is going to be having to process, hundreds and hundreds of thousands of borrowers who are exiting forbearance and need to get in another solution. And ensuring that our servicers are well prepared for that their call staff is trained, and that they have efficient processes for helping borrowers and giving them the help that they need is really of the utmost importance. We do have a little bit of a breather, although of course it is complicated because there is the CFPB is beginning a foreclosure moratorium on borrowers' primary residences running from September through December of this year. There are a few gaps, of course, in that it is unclear what's going to happen during the month of August when there is no really foreclosure moratorium uniformly in effect for the market. And then in addition to that, the CFPB has done a lot of good work in the rule that established that pre-foreclosure we'll call it a foreclosure moratorium just for the sake of simplicity, spelling out both categories of borrowers or categories of loans that may proceed through foreclosure, which thankfully includes abandoned properties, which we think is really important for combating blight. And the CFPB also did a lot of work kind of defining what the outreach requirements are for servicers, the communications they need to send to borrowers to help them understand their options and get them into one. The fourth recommendation related to preventing foreclosures and home loss is about ensuring the Homeownership Assistance Fund meets its needs. This is a just under $10 billion fund that was established this year to be administered by the state HFAs to assist borrowers with reinstating their mortgages or making up for expenses that they've missed because of a COVID-related hardship. It is the logistical problems. The logistical challenges of a program like this are huge, and a lot of it depends on the requirements that state HFAs are rolling out and the degree to which they can simplify and streamline application processes and also kind of methods of delivering assistance to borrowers. Truly, the devil is in the detail here, and we do not get into all those details in the paper, but rest assured that there is a committed group of advocates trying to work with the state HFAs and with the Treasury Department, which oversees this program, to ensure that the Home Ownership Assistance Fund is really up and running by the time when these borrowers are exiting forbearance. And we are hopeful that at least in some states, borrowers will start getting the help that they need soon. The final recommendation in this area is about supporting alternatives to foreclosure for homeowners that need them. Unfortunately, not all foreclosures are going to be preventable, but one critical difference this crisis compared to the last crisis is a lot of borrowers will have equity in their home and thus will be able to sell their home as a foreclosure avoidance strategy without having to engage in a short sale. We put forth a series of recommendations or really principles in the paper related to how to think about home sales, whether they're short or not during this period, as well as deeds in lieu and foreclosures. While I think avoiding home loss is the ultimate goal that we are striving for, unnecessary home loss, some borrowers will have to exit their home, and we want the options that are available to them to do so to be as strong as possible and as accessible as possible. Erin, do you mind going to the next slide? The next set of recommendations related to people is really about ensuring that households can access affordable and sustainable mortgage credit. Our first recommendation is about preventing the pandemic from negatively affecting consumer credit scores. The CARES Act provided some pretty good protections in terms of borrower credit scores while they're in forbearance. We do think that there is more that servicers can and other furnishers of credit reporting information can do to make sure that they are reporting things to the credit bureaus in as consumer friendly of a way as is possible. That's pretty technical details, but it's an important thing to get right. The other recommendation that we flag here is we actually think that much of the damage to credit scores isn't going to be for current homeowners, but will be for prospective homeowners, aka renters. And we could call on Congress to consider whether they should be banning furnishing of information related to rent arrearages, because we think there's a real risk that renters who have had trouble paying their rent during the crisis, whether they are ultimately evicted or not, they can still have some really negative impact on their credit scores as a result of if those things are reported to the credit bureaus. The next recommendation has to do with allowing borrowers to access new mortgages after forbearance. Both FHA and the GSEs have rules about how long after you exit forbearance you have to wait before you can get a new mortgage at a time of low interest rates. We think that these policies are misguided, and we think that there's room for additional flexibilities there that would support access to credit for those who most need help with that. And that includes refinances. The third recommendation here has to do with overlays that lenders are applying to their credit underwriting criteria. Essentially, during the peak of the pandemic, both FHFA and FHA would endorse mortgages that entered forbearance after closing, but before they were either endorsed by FHA or purchased by the GSEs. Neither FHA nor the GSEs is currently purchasing loans in that category. We think that they should be, and we think that they should be doing so without penalties for lenders, or at least with very reasonably sized penalties for lenders, in order to ensure that lenders aren't unnecessarily tightening the credit box out of a fear that they will have to pay these penalties if a borrower enters forbearance after closing. The last recommendation here is a little more of an aspirational statement. In the paper, we primarily focus on the particular threats to homeownership from COVID-19. But as we all know, we entered this crisis in a really unlevel playing field, and it won't just be good enough to kind of build back, but we have to build back better, as they say. So prioritizing equity among home buyers of the future is critically important. And while this paper doesn't offer an exhaustive set of recommendations, it does provide some framing thoughts about how to do this in the future. Erin, if you'll go to the last slide, and I'll just wrap up our recommendations. The third, I guess, bucket of policies is policies related to properties. First in this category, the paper has a lengthy discussion about distress sales, which, as everyone here knows, is near and dear to NCST's heart. We recommend that additional first look purchase opportunities, similar to the one that we offer to all of our community partners, but also perhaps also first looks focus on owner occupants as well as mission-minded nonprofits. We go through a lot of different, there are a lot of different places where sales can take place in the distressed properties life cycle, and we walk through a couple of different places where we think that first look programs should be implemented and or considered by the applicable regulatory agencies and backers of these loans. The second recommendation is about property maintaining REO properties in all neighborhoods. This gets back to a lot of NAFA's work and what Debbie talked about earlier about inequitable maintenance of properties in communities of color. And they've done a lot of work kind of substantiating the ways in which servicers oftentimes neglect or don't do as good of a job in these communities, which of course is a big risk factor when it comes to blight. And finally, we also offer a number of recommendations about preventing zombie foreclosures and ways that municipalities can aggressively address vacancy problems. That wraps up our presentation on the paper. We'd be happy to take your questions and your feedback and to have a conversation with all of you about any of that you find interesting. Before we do that, we were planning on also giving Debbie a quick moment to talk a little bit about what HUD is doing in the fair housing space. So I think what we'll do is turn it back to Debbie for a minute and then open up to the audience for questions or comments.
Great, thank you, David. And I'll be really brief. I just thought it would be useful for you all to be aware of two efforts that are currently underway at HUD that affect I think, all of our work in one way or another. One is around HUD's affirmatively furthering fair housing rule, which I hope everybody is familiar with. But this is a regulation to effectuate a part of the Fair Housing Act that's been there from the very beginning, but has largely been neglected in the 50+ years since the act was passed, which is really aimed at ensuring that HUD and its grantees don't discriminate in the way that they run their programs, and making sure that we tackle segregation and the harms that it has caused, and to make sure that we are investing in communities that have been disinvested so that people really have choices about where to live, and that regardless of where they live, they can find a community that really has the resources and amenities and opportunities that they need. HUD put a good rule in place in 2015. In 2018, HUD suspended that rule. In 2020, HUD adopted another rule that has nothing to do with affirmatively furthering fair housing. And this year, last month, HUD withdrew the 2020 rule and is proposing an interim step before going back to the drawing board, hopefully not actually going back to the drawing board, but before proposing a more kind of robust and comprehensive affirmatively furthering rule. So what it has done is to reinstate the certification requirements that were part of the 2015 rule, and the definition of affirmatively furthering fair housing that was part of the 2015 rule. So that once again, when a jurisdiction certifies to HUD, as they have to do every year in order to get their funding, that they are affirmatively furthering, it will mean something consistent with the statutory intent, with judicial rulings, and with really historical agency interpretation in this area. So that interim final rule is scheduled to go into effect on July 31st. We actually, while we strongly support what HUD is doing here, there are 3 things that we think HUD should do to make it better, so that it will have more impact and give HUD better ability to actually make sure jurisdictions are living up to their certification requirements. What I'll do is paste into the chat a link to a one-pager that we've put out that explains what we think those 3 things are. And I'll just say we're having a little Twitter storm tomorrow afternoon if folks want to join in. I'll share with David the information about that Twitter storm, just to encourage HUD to take these 3 steps and make the AFFH rule, the interim rule, stronger. And then later on, there'll be an opportunity to dig in more on a more complete rulemaking on this area. The second thing I just want to flag for people is HUD's disparate impact rule. So for those of you who aren't familiar, the theory of disparate impact is, has to do with policies that on their face appear to be neutral, but in practice have a disproportionate and negative impact on members of protected classes under the Fair Housing Act. It's a theory that has been in existence as long as the Fair Housing Act itself has. It has been upheld by the Supreme Court and every district court that has considered it, but it was undone by the Trump administration. HUD put a rule in place in 2013 that really captured the disparate impact standard as it had been implemented over the decades. The Trump administration put a new rule in place to undermine that. And now the Biden administration has proposed another disparate impact rule, essentially reinstating the 2013 rule and addressing some of the legal issues that have come up in the interim. So we're really pleased with the direction the administration is taking on this. Comments are due on that proposed rule on August 24th. And if folks are interested in knowing more about the details of that, or whether there might be opportunities to sign on to a letter in support of HUD's action on disparate impact, they should contact me offline, and I'll put you in touch with my colleagues who are leading the charge on that. So those are my 2 updates, and I'd be happy to answer questions if folks have them.
Wonderful. Thank you, Debbie and David, for the presentation and all of the work that you've been doing over the past year or so to get us through this next crisis. It is unfortunate that we hadn't quite gotten through the first one before we got to this next one. And so I know that all of our community partners are working diligently to help folks both get into homes and stay in homes. And so we thank those partners for that work. There are a couple of things in the Q&A, if either one of you wants to take these. The first one, what are zombie foreclosures?
Thanks. I know I kind of went through that one real quick, and that's partially just to try to be efficient about time. A zombie foreclosure is essentially when a homeowner, vacates a home because foreclosure is forthcoming or imminent, and then the servicer or lender does not actually complete that foreclosure, which means that it's sort of a zombie. It's it's dead, but it's alive. The homeowner remains responsible for the property. Essentially, zombie foreclosures are a real risk factor for blighted neighborhoods. And so we think that they should be taking, there are a number of different things that can be taken to try to prevent them. One of the things that we highlight in the paper is that Fannie and Freddie have actually clarified the circumstances in which they will, it has to do with, releasing of liens, kind of the technical paperwork that enables foreclosure filings, but they have basically clarified that they will not, that they will pursue foreclosure and complete foreclosure in instances where a property is vacant. And so we encourage other investors and servicers and backers of loans to kind of follow that best practice, because we kind of saw during the last crisis there are circumstances where it just people don't view it as economically efficient to complete the foreclosure because it costs money and maybe you're just not going to recover that much. And, those are just really just circumstances where people need to do the right thing, essentially.
Great, thanks for that, David. Next in the Q&A, how about a referral to a HUD housing counseling agency who can act as an intermediary between borrower and lender to secure a loan modification?
I'll react to this quickly, and then I'd love to hear Debbie's thoughts too. In the paper, in the recommendation section that focuses on encouraging communication between borrowers and mortgage servicers, we do call out the suggestion, about housing counselors and legal aid and trusted advisors outside the process can be really important in enabling this communication and helping borrowers understand their options, but also in serving as advocates for borrowers who maybe need a little more pushing on their mortgage servicer, or just to really get what they need. So we do talk about that in the paper. I don't think we don't have a terribly detailed suggestion, but we think that it is an important piece of the puzzle in terms of getting this right.
Yeah, I would just add to that, we know that people who work with a housing counselor are more likely to get a good resolution. And one area that we do mention in the paper where housing counseling agencies can play an important role is working with borrowers who are not proficient English speakers, because there are many counseling agencies who serve various LEP communities and constituencies, and who have in-house both the language capacity and the loss mitigation knowledge to be able to help those borrowers effectively through the process of loss mitigation discussions with their servicer. And that, it's a real useful resource that servicers should be taking advantage of. And in general, we support and encourage robust use of the housing counseling resources that are out there.
Fantastic. Next in the Q&A, are there any geographical trends you might be aware of related to this seriously delinquent households that were mentioned?
There are, and I admit that I don't know them all off the top of my head. So the paper makes reference to a couple of different reports that touch on where there are concentrations of households who are delinquent or households that are in forbearance and not making timely payments. I can put a little bit more of that information in the chat if that would be helpful. I think the concentration are, cities. I think a number of metropolitan regions across Texas and New York kind of scream out to me as things that I remember from having from these reports. But I'll do a little digging while we do the policy update, and I'll see if I can provide an update in the chat to answer that question more fully.
That sounds great. Thinking through that, those are definitely markets that, although were hard hit during the earlier crisis, those don't stick out to me as those that were hardest hit. So it's interesting to see some different geographies in this instance. And anything you can comment on there, David?
Yeah, well, I do think that the circumstances that ran up to the foreclosure crisis were in many ways just very different than similar. There are similar risks and threats, but we don't have the same kind of overbuilding in particular markets like a Las Vegas or a Phoenix that we had before the last crisis. In fact, even places that historically had kind of a surplus that we don't think of as having housing supply challenges, suddenly seem to really be facing them. So I'd say that the run-up is different. A lot of where the hardship correlates this time are industries that were particularly hard hit by COVID or geographic areas that were just harder hit by the virus itself. So that is what predicts, I think, a lot of the potential areas, geographic areas with more risk coming out of this crisis.
Sure. Thanks for that insight. I don't see any other questions in the Q&A. I know that there was a question in the chat around the presentation being on our website. Just as a reminder, by tomorrow afternoon, both the presentation that you saw today, as well as a recording of this call, will be available. I'm certainly happy to unmute anyone that wants to ask a question directly, and I'll continue to watch both the Q&A and the chat. And I did, Debbie and I both put up the link to NAFA's one-pager on ways HUD should strengthen the interim rule. We will also get that on our website. With that, I think we'll go ahead and move on. Again, David and Debbie, thank you so much for spending time with us today. Unbelievable information, and we look forward to moving forward with those recommendations for sure.
Thanks.
Thank you.
With that, I'll go ahead and introduce our president, Julia Gordon. And I think, I'm going to go ahead and take this opportunity for those that may have not seen the news. We are thrilled beyond belief to say that Julia has been selected by the Biden administration to be nominated for FHA commissioner. She is definitely going to be a difference maker, and we wish her the best of luck with her Senate hearing as soon as it happens. So with that, Julia, I will turn things over to you for a policy update.
Thanks so much, Erin. And, just to let everybody know a little bit more about what Erin just talked about, because I know it's a big issue. I have been, I'm very honored to have been nominated for the FHA commissioner position. There is a period of time now where we go through a lot of process, and we don't know how long it will take. I need to have a Senate Banking Committee hearing. The committee needs to vote on my nomination, and then ultimately the full Senate will vote on my nomination. And all of that could take some period of time. Just want to assure everybody I remain very much in the job at NCST. Can't afford to quit my job and just wait. So I am, full-time working on NCST things right now. And in the event that I am honored enough to be confirmed to this position, at that point, NCST will be holding a public search for my successor. So hopefully that answers everybody's questions on that front. And with that, I'm going to dive into the policy update. Certainly been a lot of things happening on the policy front since our last call. I missed our last call because I was on a much needed vacation, a thing that may never be, repeated again for quite some time. So hopefully I won't repeat very much, but a few things that have happened since that last call, in addition to my nomination. From a personnel standpoint, there was a very big development when the Supreme Court's decision came down in the Collins versus Mnuchin case that had to do with whether the FHFA director serves at the pleasure of the president or whether they are completely independent. The court ruled that position, the person in that position can be selected by the president or removed by the president without requiring cause. And as soon as that decision came down, the Biden-Harris administration, did move forward with making a change at the top of FHFA. So Mark Calabria has stepped down, and the acting director is now Sandra Thompson. Sandra has been a top-level official at FHFA for quite some time now. She's the head of the Division on Housing Mission and Goals, so she is the person who interfaces with most of the issues that NCST works on and that many of you work on. I believe she's been there since 2012, and she has a lot of experience in the regulatory world, having worked for many, many years at FDIC before she came over to FHFA. So I'm starting off the policy update with FHFA because I think there's going to be a lot of developments there relatively quickly, and certainly a very different tone and approach to the work of the GSEs than was taken by former Director Calabria. A couple of issues worth mentioning in particular. One is the removal of the adverse market fee for refinancings, which is something that, among other things, NCST has been advocating for. And the other is that FHFA is really re-engaging very enthusiastically around the duty to serve rule. Folks will remember this. I'm sure David talked about duty to serve last month. What's happening right now is that both Fannie and Freddie have prepared their duty to serve plans that will govern their activities, trying to increase service to underserved communities and borrowers. These plans cover a 3-year period. NCST has both spoken at an FHFA listening session and submitted comments on these plans. Much of our focus has been on Fannie Mae's plan because, unlike Freddie Mac, Fannie Mae does have an activity in their duty to serve plan that relates specifically to neighborhood stabilization. And that's where they are locating a lot of their work around rehab of distressed properties, whether by a nonprofit or by a homeowner using a renovation mortgage. So I would just point that out and just remind people you can always find NCST's policy comment letters on our website if you want to read more about that. A few other things that I think are really noteworthy to the audience here today. One is that the White House is right now as focused on housing supply as they have been in decades. And that includes not just rental supply, but also homeownership supply. There was a meeting the other day, I don't remember any meeting happening quite like this before, where top officials at the White House joined Secretary Fudge from HUD and Secretary Raimondo from Commerce to talk about the supply chain for supplies needed for building homes. Lumber, of course, being the big ticket item, but other items as well. And to have that kind of cross-government focus on an issue like this, like I said, it's a new development and extremely welcome, because all of you doing this work know that the disruptions to the supply chain and the consequent increase in prices across the board for building supplies is, extremely problematic for those of you who do this kind of work. And we're extremely excited to see people across the administration really focused on this most important item. A couple of other things to mention that David did touch on briefly in his presentation of our paper, but that I just want to pull out and talk about a little. One is the CFPB has released a new rule related to mortgage servicing and loss mitigation with respect to COVID hardships. That rule will essentially, it will impose something like a moratorium through the end of this calendar year, but with what they call off-ramps, where in certain cases, servicers will be able to take the next step toward initiating foreclosure. There are 3 of those off-ramps that, all of this is really important to our projections of, how much inventory we'll see coming through REO Match or coming through any other channels. So the off-ramps are vacant and abandoned properties. Another off, which, has actually been an off-ramp from moratoria all along, but many servicers were holding off, because of the blanket moratoria. CFPB has made it very, very clear that they expect servicers to move forward with foreclosures on these properties, and that they will be, and that an acceptable way to do that is to adhere to existing state laws governing the definition of vacant and abandoned, as opposed to CFPB setting some kind of new national standard on that. Another off-ramp is that for borrowers who were at least 120 days delinquent prior to the onset of COVID, prior to March 1st, servicers will be able to restart those foreclosure processes. Again, if those borrowers make contact with the servicer, they will be eligible for the various loss mitigation options that are out there, but they will need to make contact. The third so-called off-ramp is a little bit less clear than those other 2, which is that CFPB has set up a regime of outreach for the servicers, and in certain cases, if they've met certain outreach milestones and have sent certain letters and made certain calls, they are able at that point to initiate foreclosure. We do know that many of the people who haven't been in touch, especially those who never got a forbearance, a formal forbearance, but just went delinquent during the COVID period, it is hoped that for those borrowers, if they do receive a notice of default, that will spur engagement with the servicer so that they can take advantage of all these new loss mit options that are here because of COVID. So there are a few other things in the rule also. Those are the things that relate most centrally to what you all want to know, which is where is the inventory and when is it coming? So I will stop there on the CFPB rule. I also will mention that FHA has also made a couple of recent fairly significant changes in its loss mitigation activities, or the loss mitigation options that are available to servicers and able to be offered to borrowers. In particular, something FHA has never done before is now permissible, which is that in certain circumstances, if a loan modification creates at least 25% reduction in P&I payments for a borrower, the servicer can just send that loan modification out to the borrower without actually having to make right party contact with them, which, as we know, is often the bottleneck to getting helpful loss mitigation options to borrowers. So we are anticipating that maybe this week or next week, We will see additional changes to the FHA waterfall. Needless to say, I am possibly more in the dark about all of that than anybody right now, given my status. But we will let you know about it when we hear more about those changes. So I know I've talked a lot because it's been a kind of exciting time and lots of things are going on, but we have 5 more minutes and I wanted to stop and see if anybody had any questions.
Great, thanks, Julia, for all of the updates. Definitely an exciting time. Folks, just as a reminder, you can utilize the chat or the Q&A if you've got questions for Julia. I did see that there were some additional questions for David and Debbie, and it does look like those questions will be answered offline. I'm happy to unmute anyone that would like to ask a question directly as well. And while we're waiting for any questions, just a quick update. We are going to be postponing our call or canceling our call for August in lieu of a call in September because of many vacations and things going on in August. So you will not be joining us next month, but we hope you will join us the following month on the third Wednesday of September. And we will look forward to talking with you then. Where can the recording be accessed? The recording can be accessed on our website, and it will be available by tomorrow afternoon. Any other questions or comments from our community partners? All right, Julia, any closing comments today?
No additional closing comments, I don't think. I, thank everybody for your support, both organizational and right now personal. And we look forward to seeing you again on these calls in a couple of months. And of course, we are also always around to answer any of these questions in between calls. So thank you and have a great rest of your day.